Okay. Well, good afternoon. This is afternoon time. I greet you whenever you're listening or watching this video. Um, uh, Thank you very much. My name is Samuel George. So I just want to share in this recording uh, the principles of debt. All right, and this is in preparation for ICAN exams. Okay, so I'm just going to be sharing the principles of debt and how would what I would also advise on how to tackle the question when it is seen inside the exam hall. All right, please, I'm going to be very fast. Feel free whenever you're watching this video to rewind and listen to whatever you think you didn't get properly. But the principles is very much important. The understanding of the principle is very much important, and that's where we'll start um, from today. All right. Okay. Thank you very much. Okay. Now I go again. Now, debts. Okay. I say debt. Debt is an instrument. It is used to raise capital, to raise funds, to finance companies' activities, projects, and business generally. All right. It is a source of finance. So if you say it's a source of finance, you are very correct. Okay. Now, in exam perspective, I'm just going to be sharing what it entails. Now, debt is classified into two. For the purpose of the exam, please note, debt is classified into two. One, we have what is called traded debt. Traded, traded debt. And and we have what is called non traded debt. Now, by traded, I am speaking of exchange traded, exchange traded, exchange traded. So when I say non-traded, I mean this type of debt cannot be traded on an exchange. Who are the exchange? I say to people, exchange is a platform, is a marketplace. Well, it is just like a normal My 12 market or Oyinbo market or Lagos market where everybody go there to buy and sell all kind of stuff. All right. Same thing, but the difference between an exchange and a market like Lagos market or Oyinbo market is that exchange traded is an organized market. It's an organized exchange. A very good example is Nigerian Exchange Group, formerly called Nigerian Stock Exchange. Another example is FMDQ. That is what's the full meaning of FMDQ now? Financial Markets Dealers Quotation or Dealing Quotation. Okay, FMDQ. So on FMDQ exchange, that is where we trade debts the most, all kinds of bonds and debenture, commercial papers, happens on FMDQ platform. On Nigerian Exchange Group, what is mostly traded there are equities, shares. That is where you go to buy all kinds of shares you want to buy, Zenith Bank shares, Dangote Sugar PLC shares, Flour Mills shares, all kinds of shares you want to buy. Then that is an exchange. So it is very organized, such that the market happen on a daily basis, work days, no weekends, no public holiday, they don't open. All right. So, and it is a specialized market. It's not a, it's a, I always say it's a closed market. It's not a market you can just enter to buy or to sell or to do anything. Before you can enter an exchange to do anything, you must be part of the market. Is either you are part of the market as an investor or as a broker dealer or as a regulator or anyone, all right, you must be part of the market. However, on the other kind of market, I term them over the counter market. That is like Oyinbo market, Lagos markets. They are like over the counter. You can enter there anytime. You can call your dealer anytime in the middle of the night and meet and finalize your transaction. You can go there anytime and on. It doesn't happen in an exchange. Now, when I say debt, to be honest, almost everything on planet Earth can be sold and can be bought. Okay, so when I say some debts are not traded, well, on over-the-counter basis, they can be traded, all right? But on an exchange basis, they are non-traded. That's what I am trying to say. So, example of such debts are bank loan, bank overdraft. So these are the two debts that bank loan and bank overdraft, they are non-traded. But on over-the-counter, yes, they can be traded. What I mean by on over-the-counter, for example, let's assume you are owing First Bank, all right? And maybe a friend of yours that works with Money Point Microfinance Bank is trying to hustle you, trying to market you, and you tell them that, oh, your business is already taking loan from First Bank, and okay, then now said, okay, no problem. How about we pay off the loan? So Money Point is now saying the loan you have with First Bank, we will pay them off for you and we give you more loans. That's it. So for you, that's what Money Point has done there is that Money Point has bought the loan you have with First Bank. So you are not owing First Bank anymore. You are now owing Money Point, whatever you were owing First Bank, and an additional money that Money Point borrowed you. So in that case, Money Point, the bank loan or bank overdraft has traded. All right. Money Point, First Bank has sold the debt to Money Point. Okay, but that's why I said anything can be sold and be purchased. All right. But that kind of trading transaction that happened is an over the counter. All right. But here we are not talking about over the counter market. We are talking about an organized exchange market. So when I say debt is not traded, all right, I'm referring to those debts that are done on FMDQ markets, all right, on FMDQ market, maybe New York Exchange, maybe NASDAQ, maybe Dow Jones, maybe some other exchange, maybe Johannesburg Stock Exchange, anyone, or maybe NGX, okay. And we have some other exchanges in Nigeria like AFEX, like Lagos Commodities and Futures Exchange. All right. So those are the exchanges. So bank loans and bank overdrafts cannot be traded. Now, when we are in the exam, what we normally face inside the exam, okay, examiner normally has cost that, okay, for all this debt, what is the cost of debt and what is the market value of debt? If it is non-traded debt, cost of debt is equal to interest, cost of debt is equal to um, it's equal to interest times net of tax, 1 minus T. T is tax rate. T is tax rate. Then what is the market value of debt if it is non-traded debt? The market value of such debt is book value. Is book value. It is book value. Now, what is book value? In exam, if we are going to do anything about debt, is either examiner just say it in terms of essay writing, or examiner give us balance sheet or statement of financial position. Maybe they will give us in full or they will give us extract. What I mean by extract, they will just give us equity side and debt side, or they will just give us only asset side and leave the rest. That's what I mean by extra. They won't give us a full balance sheet. But don't worry, examiner is going to give every information that is needed. All right, so when they give balance sheet, the debt that we see inside the balance sheet, the figure of the bank loan inside the balance sheet that examiner is providing, and that's what is regarded as book value. If you open a company's book today and you see their balance sheet or statement of financial position and you see bank loan there, maybe they say long-term loan or something loan, or the figure you see beside it is known as book value. So if you are faced with it in exam and the type of debt that you are facing in an exam situation is non-traded debt, for example, bank loan, and you need, I repeat, and you need the market value of the debt, just go inside the balance sheet and say, okay, what's the bank loan here? What is the figure of this bank loan? Oh, 780 million. Just pick that 780 million as the market value. Now, so I move on to the other types of debt. The other types of debt, which is under the traded debt. Now, traded debt is also classified into two. Traded debts are classified into irredeemable. They are classified into irredeemable. Irredeemable debts and redeemable debts. So when I say redeemable and irredeemable debts, so the word redeemable means the debt will be paid back. If your company borrowed money from the public, the debt will be paid back. If your money, if it is borrowed from the public, it will be paid back. If it's going to be paid back, it is redeemable. That's when they say you are redeeming your debt. If it is irredeemable, it means you are not paying the debt back for life. Now, very quickly, let me quickly share. I will come back to redeemable and irredeemable very later, but let me quickly share examples of traded debt, just like I shared example of non-traded debt. That I said non-traded debt are bank loan and bank overdraft. So let me share examples of of traded debt. Okay, I move to the next slide now. Now, example of traded debt. Okay, example of traded debt, or you call it exchange traded debt, or you call it exchange traded debts. I have bond, all kinds of bond. I have debenture. I have loan stock. I have commercial paper. This one is short term. Then I have loan notes. Then I have preference shares. That is what America will call preferred stock. All right. And all and any other traded debts. But bond is like the most popular of them all. I am just trying to state these because these are some of the things examiners state, so that when they state it, when you see it in the balance sheet, oh, this is preferential, oh, this is bond, this. Just know that examiner is giving you traded debts. Another one we can say convertible bond or convertible debenture. It could be convertible debenture or convertible bond or convertible loan stock and so on. Okay, so convertible means that this type of debt, there is element of equity inside. If you subscribe to this type of debt, you have option to convert your debt to equity later or before maturity. So, all right, so please take note of all these examples. Please, examiner is not going to say, this debt is a traded debt, this one is non-traded. No, they will just give the name, oh, bank loan. Once you see bank loan like this, just know that it is non-traded debt, or loan stock. Once you see loan stock, loan notes, just know that, oh, it is traded debt. Now, let me go back to redeemable and irredeemable. So I'm going to start with irredeemable. Okay. So when I say irredeemable debt, how do you do it? Now, under irredeemable, how do we calculate cost of debt? Cost of debt is equals to interest times 1 minus tax divided by market price x int. All right, that is the formula for cost of debt if it is non redeemable, if it is irredeemable debt. And what is the market value? The market value of the debt, it is equal to, I'll call it unit price. I call it unit price divided by units, okay, times book value, times book value, okay. This formula that I wrote here, which I call the market value of debt, all right, it is going to give us, the value of debt in totality. You can say I said unit price. Unit price is the price of one debt. So I want to now convert the price of one debt into total. So the price of one debt is 1,050 naira per 1,000. 1,000 is one debt. Okay. Then I now say convert it. How many debts do we have? We have 5 million debts. So convert it to 5 million or convert it to 500 million. Okay. So that is what I will now get price for 500 million debts. So that is the formula here. But how are we going to calculate the unit price? I'm going to demonstrate that later. Okay, now, so this is just a formula. Please, you can see that the cost of debt for irredeemable, the formula is different from the formula for the cost of debt of non-traded debt. I repeat, the cost of debt formula for irredeemable, you can see that it is different from the cost of debt of non-traded debt. You can see non-traded debt, the cost of debt is interest times 1 minus tax. That's all. But if it is traded irredeemable, the formula is going to be interest 1 minus tax times 1 minus tax divided by market price x int. Now, what is the meaning of x int? X int means that market price must be stated excluding interest. Excluding interest. Once you see that, oh, the market price of this debt is 1,050 and interest has just been paid, that market price is X int. Sometimes examiner will state it and they say the market price is 1,050 X int or 108 X int. If they don't state it, all right, they may say, oh, interest has just been paid. Okay. The opposite of X int is cum int. It is cum int. That is the opposite of X int. It means interest is included. So if the market price that you have is cum int, you have to calculate the interest and take it out of the interest. I repeat, you have to calculate the interest and take it out of the interest. Let me quickly come up with a very short illustration to demonstrate this. Now I say, I say brisk coal. Okay, I say brisk coal has in issue 9% irredeemable debenture. Irredeemable debenture. Irredeemable debenture with the current market price of 1,080 naira per 1,000 naira. Okay. Interest is yet to be paid. Interest is yet to be paid. Calculate costs of debt. So they said we should calculate cost of debt. Now, very quickly, what is the KD? The interest is 9%. Okay, the interest is 9%. What else do we need inside the formula? Okay, assume tax rates is 20%. So tax rate. So what else do we need? We need the interest, which is 9%. We need tax rate, which is 20%. And we need market price of the debt, which is 1,080. Now, they said the market price is 1,080 per 1,000 naira. Interest is yet to be paid. What it means is that the market price we are seeing has interest inside of it. It has interest inside of it. It means the market price is cum int. So the very first thing we need to do is to take away the interest out of it. So let us calculate it. Okay. Now, I would say, what is the interest? Interest that you will collect as an investor, we call it coupon, which is equal to coupon interest. We call it coupon okay, which is equal to 9%. That is 9 divided by 100 times 1,000 naira. Why am I multiplying it by 1,000 naira? You can see that they said the market price of the debt is 1,080 naira per 1,000 naira. It means 1,000 is the number of, is one debt. So you are going to collect 9% on every 1,000 that you invest. So that is what it means. So if I punch my calculator and I say 9 divided by 100, that's 0.09 times 1,000. I got 90 naira. 90, I got 90 naira. Okay. So that is our coupon. Then I will now say market price X int. Market price X int. It is market price X int is equal to 1,080 minus 90. That is because 1,080 is cum int. 1080 minus 90. I got 990. All right, 990 naira per 1,000. That is our market price X int. Therefore, our cost of debt will now be equal to 90 naira, which is our coupon and interest. Tax rate is 20%. That is 1 minus 0.2, close the bracket, divided by 990. times 100. It has to be in percentage. So I say 90 times 0.8. That is 1 minus 0.2 is equal to 0.8. That is, I got 72 divided by 990. I am get times 100. I am getting 7.2%. 7.27%, approximately 7.3%. So that is our cost of debt. All right, if it is irredeemable. Now, what if examiner give us the market price of the debt and is already X int? And they said, oh, the market price of the debt is 1080 X int. Or they say the market price of debt is 1080 and interest has just been paid. Interest has been paid. You know, in this example I said interest is yet to be paid. So, but they now say interest has just been paid. So what it means is that if interest has been paid, it means the market price is already X int. If interest is paid, it means it's already X int. If they mention it's already X int. So we don't need to remove interest from it before we use it. We can just use the market price directly. Okay. So the reason we deducted 90 here is because the market price was come in because they mentioned that interest is yet to be paid. Okay. So let us move on to talking about redeemable debts. Now, redeemable debts. Redeemable debts. So, redeemable debts, it means you are going to redeem the debt to be paid back. So, what do we normally have here again? Cost of debt and market value. The cost of debt, it is equal to yield to maturity. Yield to maturity. Or some people will call it redemption yield. Or some people will call it economic yield. Or some people will call it just yield. Yield, okay? Yield is the same thing as costs. You as an investor, if you invest, you are expecting something to come back. That thing you are expecting to come back is return. Apart from the capital you invested, the other thing you are expecting to come back is return. It is also known as yield. It is yield to you as an investor. It is cost to the company you invested in because it is the company that will pay you that return. Okay, even if it is your personal business, it is still the company that will pay you that return. So the same thing we are talking about, same thing. It is cost to someone, it is yield to someone else. So examiner can use these two words interchangeably. They can just say calculate the yield of that debt or calculate the cost of debt of that debt. Know that they are saying the same thing. Now, how do we calculate all of this? We use IRR method, please, to make things very straightforward and cool. Just use IRR. There are other methods though, but IRR seems very much straightforward. Now, just use IRR method to calculate your cost of debt. That's it. You can see, look at the way it is different from the way we do redeemable cost of debt. It is different from the way we do cost of debt for non-traded debt. Please take note of all these differences, please. That is the reason I try to explain the classification initially. Now, let us move on. So under this redeemable debt, how do you calculate? So how do you calculate market value of debt? I move to the next slide. Now, how do you calculate market value of debt? Market value of debt is still equals to unit price, the same thing, divided by units times book value of the debt. Book value is also known as nominal value. Nominal value. Book value is also known as nominal value. nominal value. So this is just the price. Now let me explain unit price. A unit, sorry, not unit price, a unit. A unit is the nominal value of debts. Okay, which example, e.g., 100, 1000, 10. Some people can even say it is 10. All right, that it is that it is 10. Okay, but we are going to stick to 1000 or 100, most times 1000. So a unit is 1000. So therefore, this is the nominal value of the debt. Okay, this is the nominal value of the debt. Okay, so another thing I want to quickly explain here, I want to say issue and issue issue and redemption of debt. Issue and redemption. Issue and redemption. Now, issue means you sell the debt out. Now, if your company now you go to the market, you want to raise money, you are calling people to come and buy bond. What it means is that you are borrowing money from the public. All right. So if that bond is going to last for 5 years, it means after year 5, at the end of 5 years, you are going to pay them back the bond. You are going to pay them back the money you borrowed from them. So at the time they are subscribing to the bond, they are buying the bond from you, you are issuing it. And at the time you are paying them back, maybe after 5 years or 4 years after, you are paying them back, you are redeeming the bond or the debt. So that is why I said issue. So I want to say, and it can be issued at a price. So when they are coming to buy the bond from, they are paying a certain price. And when you are redeeming them, you are paying it back to them at a certain amount or price or value. Okay, I would say that debt can be issued at par. Okay, at par. Okay, debt debt is issued or redeemed at par if the if the issue price or redemption price is 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 equal to the nominal value of the debt. Okay, if it is equal to the nominal value of the debt, that means it is issued at par or redeemed at par. Okay, nominal value is 1000 or 100. Now, the second one, I would say at premium. At premium, I say debt is issued at a premium, okay, or redeemed at a premium if the issue price or redemption price is higher than the nominal value. That is when we say the debt is issued